Good morning, everyone. How are we doing? Day 2? We survived? Any fun stories from last night? No? Later? All right. Well, I have the honor of introducing 3 amazing guests today. We are going to be talking about everything that is involved in a term sheet and investment from 2 very different, well, really 3, but 2 very different perspectives. One from a founder, one from an investor, and then one from the lawyer who plays middleman between these 2. So I think it'll be very entertaining. Yeah, you should have switched in between so they can fight and you can keep them away. Yeah, actually, for sure.
I'm in the middle. No.
My job is to ask heated questions. But I would actually like each person on the panel to introduce themselves. I have bios, but I think it's going to be better coming from your own mouth. And one warning, Sandy has to leave at 9, so I am going to be front-loading some questions to him because he has unbelievable stories to share that I think everyone will find a lot of value in. So Sandy, go ahead and kick us off and share a little bit about yourself.
Thanks, Brooke. Hello, everybody. I'm Sandy Donaldson. I was the CEO of Impiricus up until about 2 months ago, and then I switched roles with my co-founder, and I'm now the President and Chief of Strategy.
Hey everybody, Joe Berklund. I'm a partner with Gunderson Dettmer. I work with emerging companies, venture capital funds, growth equity funds, and private equity funds in basically M&A, venture capital, and growth equity transactions. Great to be here.
Hey everyone, thanks for having me. Mike Bauer. I work with a firm called Sixth Street Partners and focus on our B2B enterprise software investing through a growth equity lens.
Amazing. All right, Sandy, like I promised, you're kicking us off. What is Impiricus? I know that you built it in 2020, right in the middle of COVID.
Yep.
Did it have anything to do with that? What was your why behind it? And tell us the starting story.
Sure. So Impiricus is an AI-enabled platform that allows pharmaceutical companies to ultimately fire all of their sales reps. So what we do is...
He says the quiet part out loud.
Yeah. No, it's not so quiet. So what we do is we work with the top pharma companies in the US, and we ultimately allow them to distribute their messaging, information about their services, about their products, and we use text message as the kind of anchoring point of this, but it's backed up by AI, lots of data, and other channels. And my why, Brooke, as to why I started the company was I was working in pharma for many years, but I saw the massive inefficiencies. So what I just wanted to do was work with my co-founder, he's a dermatologist here in Atlanta, to just disrupt everything within healthcare and provide back dollars so that more money can be spent on R&D and access, but mainly just fuck things up within the industry and really just be a pain in the ass to all these incumbents and disrupt the industry, as well as flexing my entrepreneurial muscle that I've always wanted to do.
And you have. Impiricus is huge. It's grown very, very quickly in a very short period of time. And you did that being a seed-strapped company, correct?
Yes. So our last round was a $3 million check, excuse me, at a $9 million valuation. And Joe and the Gunderson team have been instrumental in helping us since then. And we're actually now going to be doing a minority transaction looking at a $300 million check in early Q1. So we've managed to go pretty quickly.
You have. Now, talk to me about that. You had the opportunity to take on money a lot. There were investors, and it's a unique place to be in because I know that there were many investors knocking on your door saying, are you ready for another round? Are you ready for another series? And you continued saying no. Why did you say no? And what impact did that have on your growth?
Yeah, that's a great question. We've been very capital efficient. And really it comes down to our desire to maintain control. And ultimately, you can get great investors, but you roll the dice every time on, is that investor going to slow you down or not? And for Osama, my co-founder, and I, we've been very focused on, we are the people that know best how to run this company. Depending on the investor, they may push you to accelerate and to spend when you didn't need to, and it's been critical for us to make certain decisions that have allowed us to create this optimal pathway. And we've done that because of control, and also because we've managed to control our board and have almost passive investors as well. That's been critical for us.
Yeah, absolutely. Mike, actually, a question for you. When you are looking to invest in a company, what are some of the red flags when you get into the due diligence process that give you the sign this is probably not going to work?
Yeah, I think 2 of them, and one speaks to what Sandy was talking about, is the first one's alignment. And there's no right or wrong answer to that. It's just the risk appetite that the founder wants to take, the business wants to take for the return aperture that they have. And so, too many times I've seen a, quote unquote marriage fail in growth equity land when a founder either wants to run a high risk, high return business, shoot for the stars, and is okay kind of blowing up trying, and the investor wants the opposite, or vice versa, the investor wants, only 100x outcome or nothing, and the founder wants to run, responsible, capital efficient business like Sandy is, and that causes fighting down the road when it comes to making decisions around capital allocation. So I'd say alignment is the first thing that could be a red flag. And again, no right or wrong answer there, just making sure there's alignment between company and investor. And then the other one is, listen, I think all companies, some have better KPIs in certain areas, and some have room for improvement in areas. So you might have great growth, but bad retention, or great retention, but growth can be improved. And I think hiding the football early on some of that stuff, it's one thing to omit the metrics that could be improved, but it's another thing to massage data in ways that just is not accurate, and that's usually
Lying.
Yeah, ICP only retention, where ICP definition is customers that have never left. It's just that there's a lot of massaging that sometimes you just wonder, hey, if this is the way things are being presented on the front end, what am I getting into? And so that's a big watch out there, I'd say.
Yeah, following up on that, Joe, question for you. What factors do you see? Because I know that you've done thousands of deals, and lawyers actually have the purview of having gone through thousands of transactions, more so sometimes than the investment funds and definitely more than founders. So what are some of the things that impact the valuation as a whole, and what are you having to tell founders the most about how to position their business for a transaction?
I think leverage ultimately comes down to how the business is performed, and so the founders are doing the hard part. They're executing on the business. They're building the company. In Sandy's case, very capital efficiently, and they've created a massive, awesome business. That's what draws attention to the investors first and foremost over everything, and that's what gives you leverage. That said, there are ways to maximize leverage as a founder. At the end of the day, if you want to start talking to investors early and start relationships early, the average fund company relationship lasts longer than the average marriage. So there's a fun fact for you. And you wouldn't.
How long's that?
You wouldn't want to do a blind. I guess we have that show on Netflix. What is it? Love is Blind. You don't want to do that through a blind banker process where you've never met your investor and all of a sudden you're married and attached to the hip for the next 7 years. You want to get to know them early. And to get leverage as a founder, you start those conversations and relationships early. So I think that's really important. That obviously has to be balanced with running your business, right? So you want to be mindful of who you're taking introductions from, and ideally get introductions through, you don't want to cold outreach to investors. If they're coming to you, be sure you vet who you're talking to, and it's not an analyst just filling your information in a CRM system. You want to talk to, get routed to the right people at the right funds. I think that's really important.
Sandy, back to you. What are some of the red flags that you've seen in dealing with investors? You have had the opportunity, like we were talking before, of taking on capital, and you chose not to. What were some of the red flags that you saw early on to say, actually, it's worth it for me to maintain control?
Yeah, so generally, I think you need to apply your own values and your own culture to the investors you're talking to, because you're going to be working with them pretty closely. So you want to make sure that they share the same values as you. And certainly one of our key values at Impiricus is to be humble. So what we don't like when we see these investors coming in are another finance bro that just wants to come and brag about all of their achievements, and they've got the fancy Rolex and things like this. So there's a few things that are pretty obvious. That's number one. I think it's also good to speak to other founders about what the dynamics are actually like in the board. Are they helpful? Do they just ask stupid questions because they want their voice to be heard? Do they have onerous requests for data? So these are kind of red flags where it's important to do your due diligence. Don't do any of the references, don't speak to any of the references they provide. There's no point. Go and find references yourselves where you know there's actually been maybe some friction or there's been a problem. So those are the kind of red flags, making sure that somebody's humble, understanding from their other experiences with founders that they actually can provide value and just not be negative within the board meetings.
I love that, because whoever you're bringing on, whether it is team or investors, they should follow your values to a degree. We were actually talking earlier about how you interview for your team, and you've grown very quickly, and you've had an unbelievable, I dare to say, 100% retention rate. of your entire team over the past 5 years. How do you do that? Please share some tips. And then when does that start? In the interview process?
It does. And it's interesting because as we discussed this morning, a lot of the best practices I heard of yesterday, I was like, actually, Impiricus does exactly the opposite to the advice being given to the founders. And of course, it's different for each company. But yeah, it really does start in the interview process. And we have amazing people. They are not jocks or cheerleaders. They are quirky, bizarre people that we have. And we really do put them through the grinder when it comes to the interviews. And it's not multiple interviews we do, but for example, some of the questions we'll ask is like that famous Peter Thiel question, tell me a contrarian opinion that you have that nobody else does. We like to ask people what they do in their spare time. And the example that I was mentioning to Brooke is like, if you tell us that you like Netflix and walking the dog, that's just not who we want to spend time with. We actually have an engineer we hired a few weeks ago, and I asked him, what do you do in your spare time? And he has a website where if you have a wheelchair and a part breaks, you can request him to 3D print you a component. And I was like, hired. Because these are really interesting, quirky people that have strong opinions and know how to hustle. That's who we want to hire. And then there's a other bunch of reasons as to why people stay. We treat them well, we give them autonomy, things like that. But it does start with the hiring process.
I love that. And going back to how you value a team, especially whether it's pre-revenue or, and Mike, this question is for you, how big of a weight is team dynamics when you were taking that into consideration and figuring out the value of a company?
Yeah, I'd say team is critical. It's not what hits the KPIs. It's, you know, KPIs are a point in time, right? So when you're looking to invest, that's great for that current year, but you have to get faith that that's going to continue for the next 5 years, and the only thing that can really drive that is team, right? Decision making and team. And so, you know, I think everything Sandy said is pretty on point with, we want driven, gritty teams that aren't afraid to roll up their sleeves and that are really, passion is the only word that comes to mind. I think that's why we love founders that come from industry. They've seen a problem bother them for so long in their careers that they're just hell-bent on fixing it. And that passion is what we're really looking for, because that's the only thing that's going to sustain over, you know, a decade's time.
True. Joe, question for you as we're going through and representing companies all over. What is one thing that most founders don't realize about how investors are actually sourcing their deals?
I talked about this a little bit ago, but it really is the average check usually comes after meeting a founder a year earlier. Or sometimes they're tracking for 18 months, you know, and longer, depending on the stage. So that part's really important. I think knowing that investors are talking to each other and talking to other people in the industry, and even talking to lawyers like me a lot. You know, I refer investors into good companies, and you know, good investors to good companies. It's fun to play matchmaker. So a lot of deals get sourced that way as well.
That makes sense. Yeah, and it probably is better that way too. You're able to assess, going back to what Sandy was saying earlier, you're able to assess personality, direction, you know, the different types of deals that maybe they've done in the past.
Yeah, and certain investors have a good reputation in market, and certain companies have a good reputation in market. So you can put good people with good people, that's great. If it's not a match, they can figure that out for themselves. But generally putting those two together is a good formula.
Yeah, that's great. Sandy, there's a lot of conversation around how transparent is enough transparency when it comes to bringing your team into critical decisions. Do you tell them that you're going to raise money? Do you not? Do you just tell the leadership team? When do you tell them that? What is your take on transparency in the workplace, and at what level?
Again, we have a pretty contrarian view on this, is like, we tell our team everything. We tell them the good stuff, the bad stuff. We've told them in the past that, hey guys, we might not be able to make the salaries in 2 months' time. Now, that was a long time ago. So we do go for kind of radical candor, if you want to use that bullshit management term. So we are in the process of getting ready for a transaction with an investment bank, and all of our executive team are aware. And we basically say, look guys, every year we go to market. This is just that go-to-market session happening again. And we do that because it's important, one, to be transparent. We get a lot of trust from them and the fact that they know everything which is going on. And we need them to be able to actually prepare some of the materials and to help us get ready. And as my co-founder and I start to get pulled into fireside chats with the investors, we'll need them to actually keep the lights on as well. So again, critical to just tell, frankly, not everybody, but the people that are in your executive team, I think should all know.
Has there been any confusion or fear, lack of clarity, or do you find that they appreciate being brought in to the tent?
No confusion, no fear, because again, we articulate why are we doing this. And with this transaction, it's to provide secondary for my co-founder and I, for our early employees. We explain that's part of the goal, but we also mention that it's for our early investors so that they can move on to their next fund too. So we explain the rationale, and we explain that we're also going to be taking some primary too. What is the primary going to do? It's going to make your lives easier. So again, just having that transparency and explaining what it's going to be used for, everyone is on board.
I love that. Time check. You're good? Okay, fantastic. Then one more question for you also as we're on this topic. You said you are contrarian, that you have more of a contrarian, maybe a different type of way of going about business. What are some of the most unconventional things that you've done so far that you can say on stage? What worked? What didn't? What can you bring us into?
Yeah, so I think we talked a little bit about the interviewing. I think that's one of probably the more contrarian things, is that we really are looking for odd geeks to come and work in Impiricus, very mission-driven people. So we have a very contrarian, I would say, interview style and process. I think the other is, we, again, don't follow the common thread in this, but we give a lot of autonomy to our people. They have a budget for our different team leaders, and it's really up to them on how they spend the budget. And we just push autonomy as far down as we can. There's unlimited PTO, there's no need to be in the office, we don't care when you work, where you work, as long as you get your stuff done. We don't care how you spend your budget, as long as the results are there. So I think that's also pretty contrarian, is that we just have extreme accountability that we push down onto our people.
That's amazing. And I'm sure it goes a long way. It probably makes a bit more of an owner mentality for your team to feel like they have ownership and a say.
Absolutely. Everybody still has equity in Impiricus. That's very important for us. Every single employee coming in, we talk around that. We talk around the value. Obviously, we can't explain around what the final value would be because of SEC regulations and things like that. But we do create this massive idea around self-ownership and accountability. Yeah.
Amazing. All right, Mike, going to you. We're going to get a little tactical now. Tell me the difference in how you look at diligence and assessment pre and post term sheet, and maybe break that up a little bit of why that would be different to begin with.
Yeah, I think this varies widely by firm. Some firms do very little work on the front end, submit a term sheet, which is super efficient with time, both for the founder and the firm. But it's harder to stand behind that term sheet because you've done less work. You know the business, not as well. And then some firms go overboard and do tons of work before a term sheet. It feels like a root canal. But I think that the argument there would be we can stand behind the term sheet because we know everything. For us, we like everyone, I'm sure, try to find the right balance. My view is with kind of 2-3 years of financials, backwards, forwards, and ARR cube, audit if you have it, cap table, like the basic 5 documents, that should be enough to get to a range on value to make sure that you're not wasting a bunch of time, both for the investor, candidly, and the company. Where I'd say the time is better spent is getting to know the business, getting to know the team outside of just the numbers, because those are pretty easy. So I'd say invest the time on getting in-person time if you can, or Zooms, dinner, or whatever, versus just going through why retention blipped 3 years ago in Q3 for a minute. I think the other side of that equation will benefit both parties better.
Yeah, very, very true. And there is a difference between those, and I think it's really hard to navigate that relationship and that process and keep it smooth all the way. Speaking of Joe, the market is wild. It has been for years, but specifically now, and I think now what we're seeing is more creative structures and the way that people are crafting their deals. What are you seeing in the market right now? And is that true, or is it pretty business as usual? And is there anything to watch out for?
So a lot in that question. I think, first of all, the market right now is starting to really pick back up. You had a very slow M&A market the past 2 years, and so there wasn't a lot of capital flowing through the system. So as a result of that, I do think I've seen a little bit more. It really depends on stage, so maybe we should frame it that way. In the early stage, there's not a lot of deviation. It's really a bet on the people more than anything. And I have seen a little bit early stage where people are asking for redemption. And what that means is the right to get their money back. That was always a hard no early stage, but now it's kind of like, I think some of the funds out there have been in some of these companies for 15 years and they want to be able to try to get their money out if it becomes a lifestyle business. So that's one unique term that I would watch out for as a founder. In the later stage, there were a lot of earnouts to bridge valuation gaps between investors and companies over the past few years. I'm seeing less of that now just because what I'm starting to see in market in like the later stage M&A is investors are willing to pay the price that the founders are willing to offer to sell, and so there's actual overlap, there's not a price gap there. So have seen a lot of that. The other thing I just add is you should just be getting your counsel involved very, very early on in the process. So some of the most valuable insight that your lawyer will have during the course of any deal is early on. What is the investor like? If they put a term sheet down, that's some of the most value you're going to get from your counsel. You want to work with somebody who does a lot of deals, knows market changes over time, and they'll advise you on what you should push back on, what you shouldn't push back on, and what you can get. And if you have an informed counsel, that can be very, very powerful. You may have an N of 1 negotiating this, but your lawyer should have an N of 1,000, right? So.
I would just jump in. I would echo that from the investor side. People think we wouldn't prefer that. We highly prefer that. And the reason is it invites a middle party who's seen both sides of the transaction enough where they can quickly bifurcate what can and cannot work. And that makes the transaction smoother, it makes it less tension, and it ultimately gets everyone where they want to go quicker. Some companies have the mindset that lawyers are for like drafting and marking up documents, and lawyers seem very expensive if you're only using them to draft and like mark up documents. What you want a good lawyer for is advice, not, the red lines are great, but it's advice on what's acceptable, what's not acceptable. How do we problem solve between what one counterparty wants and the other? And so I would echo that even from the investor side. We actually are relieved when we see that versus when someone's trying to do it all themselves and doesn't have much context on what's happening in the market or whatnot. So.
Well, I'm sure you have to educate a whole lot more when that happens.
Yep.
And then for the entrepreneurs
and
out
get
there,
educated.
For the entrepreneurs out there, reach out to your lawyer 6 months before you think you need to. We wasted a lot of time because we didn't do it early enough. And if you're in Atlanta or anywhere in the US, I would strongly recommend working with Joe and Gunderson.
Thanks,
Wow.
Andy.
They are the best.
Give them the 20 later.
Shameless plug, I appreciate it. I would add too, just to what both of you guys are saying, your lawyer should be a partner, right? Don't view that they're not just, you send them a document and they send something back to you and it's marked up and it's got lawyer changes that you may or may not understand. You want a lawyer who's technically very good. That's important. They need to know what they're doing. But to us, that's table stakes. They need to be very good, but also very connected, know market, and know a lot of people in market. It will help you get a smoother deal done. It can help introduce you to capital sources, good capital sources that are vetted, and even warn you for some of those out there that maybe aren't the best actors or that don't have the best reputation. So really view your lawyer as a partner, not just sort of a service person that you send documents to and ask them for response by Friday, right? They should be able to do that, but they should be able to do a lot more, and you can get a lot more value out of them.
That's great advice. I do think that, especially in this case, lawyers are underutilized and brought in a bit too late in the deal. Sandy, I know that we're running up on time, so I do have one more question for you as you sneak out of here. Not taking on any rounds of investment post-seed, do you feel that slowed your growth at all, or could you have done more had you taken on money? And then why are you looking to take on a round now?
Yeah, so to answer the first part of the question, did it slow our growth? It's a kind of yes and no. I actually don't think it did, because if we had vast amounts of money, we would have been thinking about how do we spend it. We would have wasted a lot of time thinking about how we spent it, and it would have been much less efficient spend than if we were just really thinking about what we had on the books. So we've been very careful about whom we hire. That's kept the culture, because we couldn't just go and hire plug-and-play executives that have been doing this for 10 years. So I actually do think it helped us to be super efficient for quite a while. Now we're hiring now we're doing a round. One is to provide some liquidity to some of the early employees and our original investors. But it really is because as we have now product market fit, we have some pretty crazy, we were at 388% NRR last year. Pharma companies are saying, what more can you do? And our product roadmap is exploding as we think about, we'll have our own pharmacy, let's create our own pharmaceutical drugs. So we do really now need a significant primary injection to capitalize on this amazing foundation that we've built.
That's beautiful. Thank you so much for being here.
Thanks, everybody.
Thanks, Sandy. Safe travels.
He's headed to Vegas. Vegas, that's where he's going. It's very exciting. Okay, back to you all. I have seen before, it's a competitive market. And let's say there is a founder, much like Sandy, who's built an exceptional business, and there are a lot of investors who are trying to get their hand in first and early. What happens when maybe an investor gives an LOI that is far too inflated just to appease the ego of a founder and maybe get the deal in first? What have you seen that happen? And what's some advice in that process?
I could take that one. So I have seen it. Investors, and really the practice is when you send a term sheet and a company signs a term sheet, there's typically an exclusivity provision. It depends how much leverage either party has on either side, but so that the investor can spend time, money, lawyers, other technical diligence, and be protected, it prevents the company from talking. That's what an exclusivity provision is. An exclusivity provision is it prevents the company from talking to other potential investors out there. What happens is you'll see in a competitive process, some funds will submit a very competitive, very, very high price, big multiple term sheet or LOI, whatever you want to call it, and then they'll retrade when they're under exclusivity and at a time when the company can't talk to anybody else. It's kind of a way to cheat. And sometimes you'll see a deal where a founder has a $100 million check sitting at their doorstep, but it's not the same deal they signed up for, and that's a really hard no to say. If you're an entrepreneur who's been working hard, underpaying yourself for years, it's really hard to say no in those situations, even though the deal has been retraded, is what they call it in the industry. So you see it from time to time. Some funds they have that reputation much more than others, and so that's why the diligence process that Sandy mentioned and that Mike talked about a little bit is really important. Know who is potentially investing in you, and know if their word is good and their reputation is good.
Yeah, I'll just hop in. I think there's two situations where this happens most commonly, and I'd echo what Sandy said before, which is reference the firm thoroughly, and you don't need to rely on references that are provided by the firm. Like, firms are doing full diligence on companies, blinded, without permission. Like, they are asking your customers, your partners, what they think of you. You should do the same back. You don't need to ask permission to do a reference check or try to find someone's reputation. So I'd highly encourage reaching out to the founders they've worked with in the past, the deals they've done in the past. Deals are getting more public. That's easier to do than ever. On the other side, I'd say it's really important to go into a term sheet, in my opinion. This is what you guys can do to protect yourselves on the company side with full transparency and an investor that feels comfortable. Obviously, you want an investor to be at a high valuation, right? Like, that's, of course. But you don't want to push someone to a level where it's super uncomfortable, because then every little thing that pops up in diligence, it's just human nature. They're going to be more sensitive to that, right? Let's say there's a house that the buyer knows $1 million, the market knows $1 million, and the seller knows $1 million, and somehow the seller pushed the market up to 1.3. That's good, but it's also, that inspection report is going to be that much more sensitive, because you're going to want more perfection out of paying that high of a premium. So I'd say you want a good price, but you want also someone who's comfortable at that level versus someone who's on edge at that level. And then, the stuff that's going to come up in DD, just get out of the way with before the term sheet. When it comes up in the middle of diligence, people are reacting on really short timelines in really, high tension situations, and tend to overreact because of that. And so I think those are the two tips that I'd have.
I think that's really, thank you for those tips. I think that that's really, really great advice because, yeah, of course, you want a high valuation, but if it makes everyone uncomfortable in the process and it's not something that's necessarily achievable, it's going to put everyone on edge the entire time and probably create far more work for the founder in the long run. We were talking earlier and kind of laughing that people spend more time on background checks for a mid-level manager than they do background checking their investor. What are some things that founders should be doing and questions that they should ask potential investors to make sure that they're bringing on someone who's going to match with their values, match with their team, and be a solid partner?
Yeah, I couldn't agree more. I see that all the time. I'm shocked even when we're talking to companies. I ask my portfolio companies, like, hey, someone reach out over the last 2 weeks for like getting close on a term sheet, and sometimes they do, but most of the time, I'm shocked at how many haven't been contacted. So yeah, reference thoroughly. I think that's like, again, critical. And then the other things you could do is like just diligence shouldn't be a one-way street where just investor peppering company with questions. Ask questions back. So of the last 20 deals you guys signed up in exclusivity LOI on, how many of those actually closed? How many of those actually closed at the price that they signed up at?
That's a great
Show
question.
me an actual track record of that. This is like, it's not perfect information, and maybe there's a gray zone on some of them, but that should be able to be provided. Like that's one of the things we've actually started providing in our kind of pitch deck for an LOI is like, hey, here are the last 10, 9 of them closed, 8 of them closed on the actual price. Here's the one that didn't because that morning tariffs got announced and revenue dropped 20% or whatever the case may be. But I think that's important to talk through. So,
anything to add there?
You hit the nail on the head. I would be curious what like a statistic just for the audience would be that just conversion rate, I guess, on those LOIs might be the question. I would add at the early stage, which that'll be a lot of the people in the room here. You tend to see that less often because there's less work and money that go into the front end of a deal. So the retrading under exclusivity part where they retrade on valuation is less of an issue. It tends to happen more often in a really competitive growth equity stage where there's just more money chasing after the same company. I see everybody's sunglasses on. This is great.
There you go. Yeah, we were at the panel yesterday, and this is a shameless plug for me. We were at the panel yesterday morning, and I couldn't see a thing, and I called my team, and I was like, please don't hate me. Find sunglasses and get them here by 8 a.m. And they did. Thank you. They did. Going back to Joe, I want to follow up on what you said. What piece of advice do you have on how founders or even investors can better manage their lawyers in this process? When do lawyers get too involved or risk adverse, or when there's a misalignment across the board? How can we better manage?
I mean, I think a lot of it starts with picking the right lawyer, and advice I always give to companies and funds, candidly, are you want to work with a busy lawyer. They're usually busy for a reason, and they're busy because people like working with them, they're good at what they do, and there's a term called they're commercial, meaning they're not getting into lawyer battles over stuff that nobody cares about. They're helping solve problems to get things done, not just finding minutia to fight about that nobody cares about. So I think that's the starting point. In terms of managing lawyers, again, you want someone who is going to have a partner mentality where, and by that I mean a partner to you. They're in the foxhole with you. You can call, text them 24 hours a day when you have a problem. You're built if on the founder side, and on the investor side, candidly. Like if you're in a deal, time is very sensitive. Time matters. Time kills deals. And oftentimes you give up leverage if someone's not responsive. So being very responsive is a really key, critical thing that you want in a lawyer. And I think as far as managing your lawyer, this is maybe a self-interested comment, but realize that they're a person. So you don't want to treat them kind of like, you don't want to treat them poorly because if they're busy, they've got a lot to do. There's pressure, but manage them, to get the best out of them. And maybe some people work the best if they're being treated poorly, but I think for the most part, manage them, proactively. I would also say, like, one other suggestion is when you're in like a term sheet negotiation process, if you're on the company side, the fund is going to be much better at negotiating terms than you. because they do it all the time. It's part of their job. So a lot of times I've seen, I'll be a company side, and an investor will reach out to the company to try to talk through open legal points to try to knock all those points down. And the founder doesn't know the difference, but then all of a sudden you get the message back from the other side's counsel and they say, oh, this has been all agreed at the business level. So be careful of that when that happens, and just caveat everything to say, hey, just got to clear it with my counsel. I mean, it's fine to talk at the business level to knock down points, but just talk about it with your counsel before, and caveat that in any business level discussions.
That's great advice, because yeah, sometimes you just innocently start answering questions and not realizing what you're answering.
Yeah, and I think overarching though, you want somebody who's commercial, and that's a really important point. Not somebody who's going to be fighting the lawyer fight. So.
I just add in commercial and focused on transactions and raising capital. I can't tell you how many times I've dealt with at the early stage someone bringing in their real estate lawyer or their estate lawyer or something like that, where they just are not used to any of these terms, and it just creates, it'll add 3 months to the process and a lot of unnecessary back and forth.
Oh yeah.
It's just like they're like family lawyer who they're comfortable with, and that's fine. But there's specialties within law, just like there's specialties within medicine. For
medicine, yeah.
There's nothing. This is one of my favorite quotes, and thank you for bringing that up. There's nothing more expensive than a cheap lawyer. So just keep that in mind. You don't want to work with somebody that has blank blank real estate law at gmail.com as your counsel if you're raising capital or building a high-tech company. It's going to create problems. I'm dealing with that right now, and it's much more expensive to fix all the stuff they did wrong than it would have been to have just done things right in the first on the front end. So work with a lawyer who's used to raising capital and helping build companies if you're on the company side.
Yeah, for 4 times the amount of hours at 50% of the cost is not cheaper.
Math is not math. Yeah. We're about to open it up for Q&A, but I do have a few final questions. Mike, you've gone through this process a lot. I mean, your firm, Sixth Street Growth, has invested $10 billion. I want to say that's a lot of money. How do you manage the relationship process the entire way, from the initial term sheet to the final closing of the deal? I know that things can get heated. There's a lot of negotiation. There's a lot of disagreement. And like Sandy was saying earlier, it's so important to find a partner, an investor that you feel partnered with and aligned with, and so that relationship is really important. How do you maintain a healthy relationship during all of the back and forth that is due diligence, which is a miserable experience for all people involved?
Yeah.
Sometimes.
I think the key things are setting expectations correctly up front. Too many people go in thinking it's going to be super fast, super easy, and a sprint. And that, just that expectation and mindset can set a transaction up to be a tortured process. So just be clear and upfront about, on our side, how long it's going to take, what providers we're going to use, what not. On the company side, ask those questions to get it level set and know that it's a little bit of a marathon at times. Third parties play a huge role in helping. Company and investor shouldn't be arguing over whether it's 15 business days or calendar days, right? Like, let folks who've seen 1,000 transactions this month do that and say, hey, it's usually this. And then last, when there are things that aren't aligning perfectly, you've really got to ask the why between why someone cares about one term versus the other. It's not just, okay, 15's market, no 20's market, and now we're just going to, be standing still. Understand why that matters to the founder, and then same for the investor, right? Why does that matter? Why might a redemption be super sensitive to an investor right now? Because money hasn't come out of the system in 10 years, and that's part of their fund structure. And maybe there's a way to, and this is where advisors come in, there's a way to problem solve from a first principles basis versus just arguing over what's market and what's not, is understand why people care about certain things.
And I'm sure that's wildly revealing, too, of the mindset, what's important to them, and could raise some red flags or help you better move the deal forward.
Totally. You'll learn way more about what that investor is interested in, both from a risk-reward perspective, from a duration and time perspective, and then you'll learn what matters to the company and why. And so that's a way to get to know each other also through maybe a more technical lens, but it's very helpful.
One piggyback on that too. your lawyer should be able to knock down a lot of the business points. That you don't want someone who's just taking an issues list and asking, what do you want to do? What do you want to do? What do you want to do? They should be able to guide you on what's appropriate, what's market. Otherwise, if you're just left to answer all those questions, it's not an efficient process, and you'll have a lot more back and forth. So you want someone who's helping cut through all the noise and get to the stuff that really are sticking points and that do matter. So that's very important in terms of managing a deal for a smoother transaction.
Any final thoughts before we open it to Q&A? And I mean, are you going to be able to invest in Sandy's business? He's not here to say no. Did we close the deal for you?
We've got a term sheet in the works. It
there
sounds
we
like
go.
a nice business.
I'm his proxy. We'll take it under advisement.
Joe approved it already.
There we go. Any final thoughts as we open up for QA? No? All right.
So let's hit QA.
Any questions out there? All right, right over here. Okay. So what he just asked, oh, thank you. What he just asked is talk about the team. What is important when it comes to the structure of a team? Do you put more weight and emphasis on full-time, part-time, contractual? Does that actually have any impact in the term sheet?
I would, on that point, I don't think there's a right answer between full-time and fractional. I've seen companies that have done all versions of what you just said really well. The thing that I would stress is getting your ducks in order before a fundraise is really important from a foundation infrastructure perspective. It can avoid a lot of time, miscommunication. And so the mistake I see all the time is they want the full-time person. They're refusing to work with fractional, but they take forever to they're not finding the right culture fit. They're not finding the right skill set because it takes a really long time to hire, a CFO or VP of finance, whatever it may be. And so if that's starting to be an issue, I would just go fractional. I would not wait on it if you're not finding the right person quickly. And I think fractional, there's a ton of great providers out there who have seen so many different businesses, so they'll have a better purview than just a single person can. And so it really comes down to timing and making sure you have it 6 months ahead of a round versus the worst is when someone's trying to hire that either person or fractional during the round, and it's chaos. So,
Eric, Spet. It's nice when I know by name.
I think this is for Joe, and I'm kind of sitting behind this light that's blinding you. 2 questions. One you might not have an answer, but have you had to represent a firm that sort of bait and switched a term sheet as you got to the final 5-yard line?
That's a great question, and I'm just racking my brain. I mean, I've seen deals where I've represented a fund where the company missed its numbers, and there were all these diligence issues that came up that they didn't know about ahead of time. And so it was kind of a fair rationale to say, listen, the price that we thought we were getting into here isn't a fair price, so we're going to need to have either coverage in terms of terms, like specific indemnities in like an M&A deal, or we'll need a ratchet in valuation or a slightly lower valuation, just because like your customer numbers aren't, your ARR numbers aren't really what we thought they were when we entered the term sheet. So I have seen that before, and it's really more the funds that do it as a behavior and as a practice to try to just get into really competitive processes with a really big number and very little structure, and then they come back and they do it all the time.
Have you been on one of those?
I have not, but I know a few funds out there that have a reputation for doing that. No names to be given here.
And then piggybacking, how many deals do you think you've done in your career?
I always just say, probably 1,000. I mean, I've done hundreds, about a mix 50-50 company side to investor side.
So how many have you seen where like LOI was signed, got through diligence, and then fund doesn't do the deal?
It's rare. There's funds that have that reputation more often than not. I'd say maybe 2 to 3%, but a lot of that is where the companies, my clients, at least on the company side, tend to work pretty closely with me. And I'm going to warn them in advance, this fund has a reputation for retrading. So go in eyes wide open if you're going to sign an exclusivity agreement.
Cool. And which funds are those? If you could just.
Oh my gosh. We have
All right,
time
I'm
for
done.
one more
I'm done.
question. Take the mic
no
away
comment.
from Eric.
Hey, Joe. I really enjoyed how you said that founders should work with busy counsel. I totally agree. What's the best way for founders to, across the medium term, manage that, know how to keep you updated on where the company is at, and just make sure that we're well positioned for when we do need something?
So the best, and the question was, so the best way for founders to just keep their counsel updated while they're running the business. I think just regular check-ins, like a quick email, like, hey, we just had a huge contract or had a huge month, great growth this month. That's important because, and especially if you're looking for introductions to capital sources. I'm talking to funds all the time, and if a fund's talking to me, I'm like, hey, X and XYZ company is crushing it this past quarter. You might want to follow up with them. They'll do that. So that's a good, like a low impact type check-in. I think is perfectly appropriate. That makes sense.
We have 2 minutes. Does anyone have one final? Oh yes, right up front.
Good morning. How are y'all?
Good.
So, if you are considering actually having to move entities from like a LLC to a C corp, and yes, I'm working with the startup, but I don't meet with them until like next week. But what are some other things that we should be thinking about from a lawyer standpoint, but also from an investor standpoint?
I'll take that one first because it's probably a little more legal. Just and we can chat offline after this too. But it shouldn't be that expensive unless you've got a lot of people already on your LLC cap table. Just some quick bullets to think about. Debt in excess of basis. If you've raised convertible notes or have any debt or personal guarantees on the LLC, converting can create problems then. So you want to work with your accountants and lawyers to make sure that's buttoned up. And work with an experienced lawyer who is used to convert. It's a very common process to convert LLCs to C corps. The other thing I'd think about is what's your basis in the C corp stock to maximize your potential qualified small business stock exclusions. So we can talk more offline just to spare everyone the legal, the boring legalese.
Well, thank you so much. And before we give them a round of applause because they have earned it, please make sure that you are staying here because there is an executive panel preview that is happening in about 3.5 minutes. So keep your seats, and in the meantime, please give these wonderful guests a round of applause.
Thank you all.
Thank you for being an excellent audience. See you out there.